All right, we're going to get going. Welcome to the True North webinar series. This is a fun topic today, understanding insurance. Again, I'm Jake Rushton, and got Brett Weston here, who's one of the deepest brains in our team, and he knows a lot of stuff. And today I'm really excited because some of the things he's going to cover, I definitely wanted to learn myself personally. I've been around insurance most of my career, but more on the investment side. So this is going to be a good topic. I think you'll learn a lot, and we're going to record this so that if you need to share it with some family or friends, it'll be available on our blog. So let's jump in. We're going to show you some slides here that will help understand insurance a little better. So Brett, let's jump in. The insurance basics. I mean, there's a lot of things we think of insurance. Number one would be the cost, which is another term we use is premium. But yeah, kick us off, get going on the basics, make sure we have a good foundation under us first.
Yeah, so kind of the purpose of insurance, when I go through this, it's going to sound like I'm against insurance, but I'm not. I'm definitely against approaching it incorrectly. And so when we go through this, we're going to approach it from a standpoint of managing risk, okay, rather than just buying insurance because we're told to buy certain insurance. Okay, so this approach is going to be more how to analyze your personal risks and when insurance would apply. So for the monthly premium, we all know is what we're paying a month for insurance. Okay, and it's really important to break this down into its components to realize what you're actually paying when you're paying this monthly cost. You have the cost of insurance, okay, how much it costs to insure yourself. The insurance company has administrative fees, and then on top of that, they bake in their profit margin, okay? So these are all the things that are kind of baked into the premium. And there's a couple of important concepts to understand to realize why, insurance should really be a last-ditch effort to manage risk. And there are times where, it's absolutely applicable, and we'll go through that. One of the first things is moral hazard. Okay, so moral hazard, as it says here, is the lack of incentive to guard against risk where one is protected from its consequences. Okay, I think all of us kind of succumb to this to some extent. I bike everywhere. I bike a lot of places and ended up getting bike insurance. And I noticed a difference in my behavior. A lot of people could probably relate with getting health insurance, anything else. But when I got bike insurance, I noticed that I wasn't really locking up my bike, everywhere I went. I was just kind of leaving it out. I was a lot more lax in my behavior. Insurance companies or underwriters, the people who determine how risky you are, actually include this in their risk calculations, okay? So it's, something important to consider. When you're paying a premium, you're paying for everyone else's riskier behavior, when they have insurance, okay? One more concept that I, didn't add into this slide is the concept of adverse selection. Okay, adverse selection is the fact that the underwriter has a lot less information about your lifestyle than you do, which means that people who need insurance or need a certain type of insurance are more likely the ones to buy that type of insurance, okay? So the people who are more likely to need health insurance, for example, are going to be the ones buying it versus the ones who don't. Between moral hazard, adverse selection, which kind of goes into the cost of insurance, the administrative fees, and the profit margin, you're really paying for a lot more than maybe a lot of us
And just
realize.
the risk you have,
Yeah,
right? That's the idea is your premiums are really built upon assumptions that may or may not line up with how your behavior is acting. In general, we think, well, we're buying health insurance to go see the doctor. Well, there's a lot of people buying health insurance, and a lot of people take care of themselves differently. So that is built in as across the board as an assumption. So there's a lot going on behind the scenes with insurance, and I think it's interesting to kind of, those 2 points are really key to understand how things are priced,
right?
Because there's more to it than just if you actually have that risk happen to you.
And so the underwriter, is the person who basically looks at your application when you fill it out. they do not do a very good job at getting to know you. And so you end up being categorized by this underwriter. And the category you're in isn't typically the category that you should be in, okay? Whatever category you get placed in, you are, swimming in the same pool, so to speak, the same risk-sharing pool as everyone else in that category. So it's vital that you get categorized correctly so that you only insure what you absolutely need for given your lifestyle and your risks, right? So, and then the last thing is, as the likelihood of loss approaches certainty, the premium approaches the cost of the loss, okay? And I'll come back to that when we go on to the next slide here.
Okay. I love this slide because this helps you, I think, throw activities and your lifestyle in certain categories. And go ahead and explain it, Brett, and where we want to focus our attention on this slide.
Yeah, definitely. So this is coming back to kind of what I said earlier. We're not just trying to buy insurance because everyone has the same type of insurance, right? It really comes down to managing the risk in your lifestyle and how to reduce it and mitigate it, so that you don't have to blow up your financial plan along the way because of a hiccup, something that happens in your life. So this risk management matrix is on a scale. On the x-axis here on the bottom, we have the impact or severity of the loss that we would experience, okay? Is the severity low or is it high, okay? And then we have the probability or frequency with which it occurs, okay, low to high on the y-axis there. So let's go on to the next slide, and then we'll kind of jump back and forth here as we look at these activities. Okay, so we have some examples here. We have loss of income due to disability, having a pool in your backyard, free solo climbing, and having $500 worth of jewelry stolen, okay? So let's start from the bottom going up. How frequently does jewelry get stolen out of your house, okay, or out of your residence? It's not too often. And $500, it's it'll hurt, but it's not life-changing if you experience this loss, okay?
I literally had this, not jewelry, but I had a neighbor, their son's bike got stolen, right? The bike was worth $500. It was brand new. He saved up all summer. That was not enough of a loss to basically pay the deductible on their their homeowner's insurance to get the insurance to jump in. So here we are paying all these premiums every year for our homeowner's insurance. Something gets stolen. We don't even engage the insurance company because the costs aren't high enough to pull them into it. So it really just depends. And some people will treat that differently, and maybe they would do a claim. In this scenario, we got the neighborhood together and got some money. We actually got the kid a new bike. And his parents were so thankful. But yeah, that's a definite risk where you have to kind of figure out what is it going to cost you over a longer period of time should you engage an insurance company, because it can impact your premiums.
Right. So if we go back to the previous slide real quick, we'll kind of try and put these into these categories. The $500 worth of jewelry, it's very low impact. $500, no one wants to lose that, but it's not worth insuring, and it's not going to happen very often. So we're just going to go ahead and accept that risk, and we're just willing to pay for it if it ends up happening. There's no point getting insurance. It really doesn't matter.
Yeah.
When you have a pool in the backyard, right, that's something that we can reduce, okay? So that's something that could happen pretty frequently.
A lot bigger expense.
Right, exactly.
With that scenario, because there's so many things that can happen around that. So obviously there's bigger risks to having that.
Yep. There's the, high school kids trying to sneak into yards, all kinds of things, neighbors, all the neighborhood kids coming over, swimming in the pool. That's not a risk that you necessarily need to avoid, but it's definitely one you can reduce by having proper fencing, having a cover over the pool when it's not in use right. That's something and in the end, you'll have insurance for it, but you need to reduce that risk as much as possible. So free solo climbing, that's a risk we probably want to avoid. People who are free solo climbing, they're not too concerned about risk, but.
That's a very specific question. I've been around insurance enough and done some life insurance policies in the past. And that's a question that the insurance company will ask. The underwriter wants to know, do you rock climb? I mean, they're very specific. They don't ask me if I'm going to go ride my bike 50 miles an hour down the road. They ask me if I've rock climbed. So there's certain higher risk activities that the underwriters know they need to be very clear and direct about, because the probability of you having that risk engage the insurance company because you're doing that activity is so much higher.
Right.
So yeah, that's absolutely something that I don't, it would be hard to have insurance for someone that's doing that.
Yeah, and I mean, you can have insurance for it, but remember, going back to the premium, as the cost of the loss or the likelihood of loss approaches certainty, the premium's pretty much going to be as expensive as the loss you'd experience. So if there's a 1 in 3 chance that you end up breaking all your bones doing free solo climbing, the premium's basically going to be, a third of the cost of the loss per month, because they're just going to, in the end, they're going to say, well, I mean, we got a bacon profit margin here somehow, and in the end, free solo climbing is not really worth insuring. Okay, so hopefully that management matrix makes sense. In terms of how to manage it. In the end, we want insurance to be a last resort. We only want to transfer risk to another company if it's not frequent or not likely that a loss will occur, but when it does occur, if it is going to be detrimental to your financial plan.
Well, and real quick, I want to touch on this top one, loss of income due to disability. This is one of the most overlooked insurance, I think, risk mitigating insurance policies that people don't take serious enough. We tend to focus a lot on our health insurance, and I think we're going to get into some of the different types of insurance, but we focus a lot on our health insurance. And then we definitely, when we start having kids and families, a lot of us get life insurance. That kind of comes up. But disability, if your company you work for is where you typically would be introduced to a disability insurance policy, unless you're a very, very high income earner and have a very specialized, something that you do very specialized that needs this risk covered. Disability, if you're a typical employee, I don't think it's an important enough topic. And the best way to look at disability insurance is this is paycheck insurance. I mean, you're literally mitigating the risk of you not being able to show up to work should something physically happen to you. And if that happens to you, how are you going to pay your bills if you don't have a paycheck? So to me, disability is something that we kind of let HR or our CFOs or whoever is helping set up our benefits plan to direct. And I think disability is one that we probably should spend a little more time understanding personally and knowing what we really have in case something happens, because the likelihood of something happening is much higher in that sense than actual death in most cases. So disability is one that I really just want to emphasize. You should understand what your policy is if you have one. If you don't, you need to figure out how to get one.
Yeah, definitely.
Okay.
Yeah, thanks for that. So some of the risks that are likely worth insuring for, okay, now we're going to come back and say, okay, we should try and reduce, avoid, or accept as many risks as possible, right, in our lives. Mm-hmm. If all else fails, if it's really in that bottom right corner of that matrix, we will definitely want to transfer the risk, okay? So health catastrophes, loss of income due to disability, loss of income to dependents due to death, and loss due to property damage or liability. Okay, you'll maybe understand these as health insurance, disability insurance, life insurance, and then property insurance we'll get into. So
yeah, all really important. So we're going to cover health insurance first, because that's typically everybody's number one, I think, individually, the insurance that they focus on the most, and has quite a few different options that you need to be aware of to be a good consumer, because your actions in your health insurance decisions, in your health decisions with your doctor, with hospitals, with different care you need, really can impact the big picture as far as how much you pay down the road. No matter what size company, there's a lot that goes into that. So these are some of the things that you want to look out for. I'll kind of, you want me to cruise through these? So basically, copay, understanding how much your portion of the risk you're going to pay. So health insurance is interesting because you're going to have claims continuously. This is one where you will engage an insurance company often. And the more active you are, the more that you see the doctor, the more things are going to happen. You're going to see a physician and you're going to have things come up. Knowing the copay versus the co-insurance. So do you want to explain the two differences so that we make sure that everyone's on the same page with that?
Yeah, I mean, copay, is kind of something they make you pay so that you feel a little bit of a sting every time you use insurance services, right? It's a $20 copay to go see the doctor for your annual checkup. Coinsurance is the amount that the insurance company pays once you hit your deductible. Okay. So if anyone's familiar with Affordable Care Act or Obamacare marketplace plans, okay, so you'll with health insurance, you have a deductible, everything that comes out of your pocket first before the insurance company kicks in. After your deductible, you pay co-insurance, okay? Typically, you pay 30 to 40% of every dollar after that, and the insurance company pays 60 to 70%, up till you hit what's called the out-of-pocket max, okay? And then there are coverage limits included in that. Okay. And then another important thing is exclusions, right? So it's important when you're signing up for health insurance, you want to make sure the risk you're trying to insure for is not excluded. So I'll kind of go into an example here on the next slide, and hopefully this clarifies it a little. Okay. So, I mean, don't get bogged down by the numbers, but we have OPM stands for out of pocket max. And the marketplace, the Affordable Care Act health insurance, right, market, kind of places a cap on how much can leave your pocket before you're done paying, okay, which is $16,300 for 2020. Their deductible typically will be around $3,000, okay, and when you hit that $3,000 out of pocket, that's in a calendar year. That's how much you have to pay before insurance does anything. Okay, so you realize, we're transferring risk by purchasing health insurance, but what are the odds that you end up really spending above that? It's only when you really experience a catastrophe. Okay, so coinsurance, you're going to pay 30% above $3,000 up until you have spent $16,300 total. Okay, so let's see the implications of that. You say, okay, sweet, $16,300 and I'm done anytime I experience a catastrophe. But how large does your medical bill actually have to be before you end up hitting your out-of-pocket max? Okay, so we'll go below here. By the time you hit your out-of-pocket max, the insurance company will have also paid $31,000, okay, given these numbers. And so you need to have a medical emergency that exceeds $47,000 before you're free and clear, okay, for the year. That's a pretty low chance that you end up hitting that, but we still recommend people get that. We still recommend there be an out-of-pocket max because, it's not likely to happen, but it would be a catastrophe if it did, okay? So whatever you have in your emergency fund or your cash reserves, whatever you can float in terms of an out-of-pocket max, we would recommend keeping for emergencies like this. Now we go to the very bottom to maximum limits. Okay, with marketplace plans, you typically have an unlimited max limit. Okay, once you hit your out-of-pocket max, you never pay another penny for the rest of the year, okay, until your deductible resets. A lot of people think that it's very comforting and that's a great thing to have, and that is a good deal. One thing I can't stress enough is that there's no such thing as a good deal in insurance, okay? It's just, what do you need to insure against? When we look at our maximum limits, we kind of think of our personal health and how likely we are to have a medical bill that exceeds 250, 500K, or 1 mil. Okay. When you buy a health insurance policy that has an unlimited maximum limit, guess whose risk sharing pool you are swimming in? You're swimming in the people's risk sharing pools who need the unlimited insurance, the 0.001% of people who end up needing millions of dollars, right, for their medical expenses. And so just understand, remember adverse selection. The people who need unlimited coverage are going to be the ones who select that coverage. And when you select that insurance, that's the people you're paying for and that whose risk you are sharing.
Right. So the unlimited would have a higher premium.
Exactly.
Basically,
Yeah.
because you're trying to protect yourself from probably the most unlikely scenario, but it's comforting to know that that's the case, but it's going to cost you a lot of money. And that's the idea, is finding the balance of where you need to be, what coverage you need to have, and then take the difference and do something with that money that would impact your retirement, your future financial independence, however you want to look at that. You can buy insurance for almost anything. And if you're smart and review your insurance consistently, you'll find and you'll see and understand yourself better than anybody else at what kind of risks you have. And of course, there's going to be some surprise catastrophic thing here and there that might happen. And you may very well have a $47,000 expense, but that most likely won't be every single year. So that's where you need to find that balance. And that's a great example to just understand the math behind it, because there is a lot of numbers that go into this, and sometimes it gets a little overwhelming. So hopefully that's a kind of a clear way to see it.
Yeah, and I mean, you know your health better than anyone else, your risks. And so, if you feel like whatever maximum limit you would need, definitely go for. But if there's an almost 0% chance of that ever happening in any given year, we could get asteroid insurance too. That doesn't mean it's managing your risk, right? So just remember, figure out what is likely to. There's a caveat to transferring risk. You don't want to just insure everything, if there's a very low chance of it happening.
On the flip side, the insurance company accepting your premiums and taking that risk on, they're basically betting against you, saying, we don't think you're going to have that problem. We don't think that you're going to have this situation, but if you do, we're going to make sure we're covered. But if you don't, we keep the difference. So it's not in your favor, most likely, to win over time, to overinsure. So that's where you need to find that balance.
Yeah, it's definitely not an investment. It's more, you
don't
got to be thought of differently.
So our approach at TrueNorth is very much to keep the separation of covering your risk and your investments separate. There's a big push in our industry to combine the two. And in that scenario, you do not end up with more over the long period of time. So we like to separate that financial snapshot, the financial work that you're doing personally with your money, from what risk you need to manage at different times in your life. And the next one being disability insurance. So I kind of hit disability insurance, but how do you buy disability insurance? What do you need to be aware of? Because most likely you got it through your employer and they've gone and selected a plan, and you don't have a lot of choice there, but these are things you need to know and maybe have questions about for your HR team.
Right. So you have disability insurance. Again, it comes down, you get this questionnaire. They ask you kind of what your job is. Okay, if you're in a high risk industry, maybe doing construction, your premium is going to be more expensive than if you're doing something in the financial services industry. Okay, so a couple terms that are important to understand to be able to analyze insurance yourself is what's called the elimination period. Okay, this is essentially like the deductible on health insurance. This is how long you have to wait before you start getting disability payments. Okay, the longer your elimination period, the lower the monthly premium. So let's say you have a 90-day elimination period. You have to wait 90 days plus a little for getting it processed before you start getting payments. And essentially that translates to how much in cash reserves do I need to be able to float that elimination period. Okay, benefit period. Sometimes if it's long-term, can last anywhere from 5 years to age 65. And obviously, all of this comes down to how much premium you want to pay. We typically recommend have a benefit period up to age 65 in case you do end up getting a permanent disability. And then hopefully by then your retirement assets can cover you from there.
And that kind of comes back to the question I get all the time in 401k plans. Well, how much cash should I keep? How much emergency money should I keep? And you hear all these different numbers thrown out, $1,000, 6 months. The next question when someone asks me that, what we should look at is, what is your disability cover? When does that kick in? What's your elimination period, and how long will you have it? Because that will tell you the gap you need to save for until you have your paycheck come from your disability policy. So that really should be the approach you take in understanding how much cash reserves and what that really would mean in that real scenario you got hurt and couldn't work.
Right.
So.
Yep. So another really important concept is the concept of covering your own occupation or covering your ability to do any occupation. Okay. You can hopefully intuit which one would be the much lower premium that would be covering any occupation. Essentially what this means is if you become incapable of doing any occupation given your training and experience in a certain industry, then you get payments, as opposed to own occupation. It's you have to be able to know, or you can no longer be able to do your own occupation, and then you get payments. And a good example is to think of, a surgeon, someone who uses their hands, or a dentist, right? If they develop a tremor in their hands, if you have any occupation on this person, the insurance company might argue that they could just go teach dentistry somewhere, and that they can still do something that's in line with their education and training. Whereas with own occupation, if they develop a tremor in their hands, they get benefits for their disability without needing to, or being forced to do a sort of a career switch within the industry. So hopefully that makes sense.
Think of the movie Doctor Strange, one of the top surgeon, right? His hands are destroyed. This is what we're talking about. He cannot do the same thing he was doing. So you have to look at your occupation. Is it something that you could pivot to if you lost a limb? I mean, there's just so many different disabilities that could come up where you could function in a different capacity. So that's where you need to understand your situation.
Right. And then cost of living adjustment, if you don't have one of these, inflation can eat away at your benefit over, the next 30 years if you end up, being disabled long term. So it's typically a good idea to have cost of living adjustment as part of
that's getting a raise every,
Yep. Yeah, there's no good deals. It's just, kind of what makes the most sense for you.
All right. So that's disability. Let's talk about life. Now, life insurance is probably one of the biggest ones that friends and family try to sell you, right? This is the insurance that I think has been pushed from a negative standpoint. And I worked a lot of my early career with a life insurance company, and I had a lot of different people that I kind of helped manage and direct as I was kind of in the back office operations team. They were selling life insurance first and investments second. And so guess which products they were always pushing before they actually talked about investments? It was the life insurance. And life insurance can be really critical during a certain period of your life. It is not, life insurance has a certain window when you need to have it and when you shouldn't if you're preparing yourself properly. So, but when you do decide life insurance, there's a whole variety of different life insurance kinds of policy. We'll talk about that. But the first thing you know is how much is it going to cost me? And that can range from $20 a month up to thousands of dollars a month, depending on what the policy will do. And I kind of put them into two. I mean, you have term and permanent there. Do you have anything you want to add on premium and death benefit before we get into the different types?
No, I mean, kind of in the end, it's just, how many bells and whistles do you want on your policy? The more you want, the more of a premium you're going to pay. Typically, we like to keep life insurance policies bare bones. Just if the primary income earner passes away, we want the dependents to be covered. Okay, there's typically not a huge need for all the bells and whistles that it typically is offered with life insurance.
Yeah, so there's a lot of ways they've dressed up life insurance to make it look really flashy and appealing and promising. Really, there's a time when you have dependents worrying about your income, and if something happened to you, we want to make sure they're covered during that time until they can take care of themselves. That's where we come into term insurance versus permanent. So permanent has a few different names: whole life, variable life. Indexed universal life is a big one right now. IULs, I hear that all the time from a lot of people. They question because there's some different tax advantages in their mind as far as how they present or sell those products. And so be very, very careful to understand the difference of an insurance policy versus your investments. There really is a lot of difference there. And if it sounds too good to be true, it probably is. It's probably being presented to you incorrectly. So we typically advise people to consider term insurance because it's a lot lower premium. You can get a few $1 million for, very, very low. Depending on what age you're starting this out, you decide the term that this will last. So you essentially say, I'll give you my real life example. I have 5 kids. My oldest is 14. My youngest is 4. I just redid my insurance last year, and I renewed it because I had a 10-year policy when they were real young, when I started to have kids, and it was up. So I wanted to redo it, and I did 20 years. So hoping that my 4-year-old daughter at age 24 or sooner will be in a place where she's married and taken care of, and I really don't have to worry about if something would happen to me that she wouldn't be taken care of. So I did that with a term policy at a very low cost. I think I pay about $45 to $50 a month for a couple $1 million. Okay. And so it's going to definitely range based on your health and your age and how long or how short you want to have the policy guaranteed for the same rate. And the idea why we push term policies is you take that difference. If I was to get a permanent policy, I'd be looking at a few $1,000s a month. So in difference, I'm putting more money into my 401k, my other retirement accounts, to make sure that I, in 20 years, will be in a better spot financially, where if I paid for this insurance policy, I'd have a lot of expense over those years, and I probably wouldn't end up with as much, because you just don't have the opportunity to take as much of the return that could come out of the market. So really think that through. Don't get sold something that sounds amazing, because there's probably something you're not catching there. So, I mean, life insurance is, to me, it gets way too much attention for what the short time and you really need it. So.
Yeah, so to play a little bit of devil's advocate, there's sometimes a place for permanent insurance, okay? A lot of Dave Ramsey followers out there will say, well, why would you ever get permanent insurance? It's much more expensive. Just get term and invest the difference
Yep.
of what the cheaper premium would be. But, we typically recommend that for our clients because they have us to be accountable to in order to make sure they're meeting their savings goals. If you don't have any accountability and someone is saying, we always spend our paycheck every month and I really don't see that changing in the near future. Permanent insurance could come in handy as a sort of forced savings program.
It's true.
Okay?
Yeah.
So there could be a place there for that. I understand that argument. If you have, the discipline to buy term and invest the difference because of the money you save, we would say go with term. But another thing is that with term insurance, it's a lot more expensive if you end up needing to buy it your entire life. Okay, term usually lasts 10, 20, 30 years. The idea behind that is that you need to be financially independent, more or less, by the time that term ends. Because if you just keep on renewing term insurance your entire life, the cost of insurance might end up, being about the same as if you were to get a whole life policy.
Yep.
So term, you kind of set a goal for when you want to become financially independent. When can you get to a point where if the primary earner were to pass away, would your dependents be okay?
Yep.
Okay. And that's the term you set.
And it's a long-term commitment. So if someone that's where I see real mistakes happen with permanent, is they start down the path of, I got to do this and I'm going to commit to it. 3 or 4 years in, they stop making the premium payments and the policy basically implodes on itself and you lose everything you put into it over that period of time. That's like worst case scenario. We hate to see that. So there's options. If you've already purchased a permanent policy, don't freak out and stop paying or make bad decisions. We can help you review that. We don't sell any insurance, but we have some options that we can kind of help you work your way out of it if it's something that you want to change. Or we would understand where it is and where it fits in your financial picture. So everybody has a unique history as far as how they approach life insurance. The last thing I want to add to this about life insurance is get it on your own directly, not through your employer in most circumstances, because if you switch employment, you'd have to go and get yourself reinsured or go through the whole underwriting process again. And that you may find something that in your health that could cause you to not be insurable. In that scenario, you'd be just out of luck. You really wouldn't be able to get a life insurance policy. So it's always good to get it in place so that if you do switch jobs, it's not tied to that one place. It's tied to you directly. It worked out for me, and I'm glad that I did that early in my career because it actually followed me along the way. So anything else to add on life insurance?
Yeah, I think that covers it. It's mostly to protect dependents if anyone's dependent on you for income.
Yep. Okay, homeowners. This is one we're all required to have, right? If you have a mortgage, you have to have homeowners. If you're renting, you have renter's insurance. So really, this all goes back to theft or fire or earthquake's a separate little component to this. And because we're in Utah and we've had an earthquake this year, that's one that was really interesting because not a lot of people don't realize their homeowners wouldn't cover that situation. So really replacing your home if something were to happen, or possibly something that was stolen, is kind of the whole point of your homeowner's insurance. But I'll let you dive in and add more if there's more that we need to cover on that.
Yeah, no, so I mean, going back to the earthquake insurance, Utah just recently experienced an earthquake, and this comes back to supply and demand. Honestly, you get adverse selection. As soon as that earthquake happened, guess what? The floodgates opened for these earthquake insurance agents, right? Everyone started adding earthquake to their policies, and the premiums for it skyrocketed because now you have a bunch of people who are high risk jumping into the pool to insure themselves against earthquake. So there's always a trade-off. Again, just always be mindful of that. The other important thing with homeowners insurance is understanding that you only need to insure for the replacement cost of your residence. Okay. It's not smart to go on Zillow or to get your place appraised and insure for that amount, because guess what? A significant portion of the value of your home is land, and you don't need owner's insurance to insure your land from fire, theft, anything else, right? In the end, it comes down to the replacement cost to rebuild your residence, and so that's going to be well below the actual market value of your home. So it's good to be mindful of that. Make sure you aren't overinsured. Also, that you aren't underinsured. If you're underinsured below 80% of the replacement cost of your home, there's some, I won't go into that, but there's some kind of pitfalls there as well.
And I would shop it out, at least maybe once a year. Make sure you have your homeowners reviewed, because I've in the past been able to switch around and lower my homeowners insurance costs, which lowered my monthly mortgage payment because I have escrow and everything's wrapped into it. So, and I have even better coverage. So just know that you might have to review it at least once a year, and you might have some savings that's worth that time.
Right.
Okay. Auto insurance. This is a big one. This one is constantly moving, in my opinion, like as far as raising the amount you're covered for. This is, to me, one of the highest risks of our lives is having a car accident. I mean, that's just, the likelihood of that happening is pretty high. And so that's why we're all required to have auto insurance. And so knowing what to look out for, I'm going to let you go through that, because these have changed dramatically. I know you review these a lot more often than I do because I'm in 401k world, but go ahead and walk us through these.
Yeah, so I'm kind of just going top to bottom here. Auto insurance has typically several sections, A, B, C, D coverage, right? One of the most important sections is bodily injury and property damage liability. Okay. So this is talking about for others. Okay. Oftentimes when you think of getting bare bones car insurance, you're just getting liability, meaning you are insured if you were to cause damage to someone else's auto or someone else's bodies, right? As in addition to, being sued because of a car accident. So this is incredibly important to have. We're going to dive into this more when we get to umbrella insurance. But then we go down to medical payments, different from bodily injury. Remember, that's insuring other people's bodily injury that you cause. Medical payments insures yourself and pays you money to help meet your deductible for health insurance, and also helps other people in your car with, typically $5,000. Okay. Collision. And comprehensive. Okay. Collision is when you hit something or something hits your car, whether you, crash into someone else, or you back into a car in the parking lot, or you hit a lamp post. Okay. That's when your car gets covered.
That's the actual car repair, nothing to do with any physical damage to somebody.
Right.
Yeah.
So, and then comprehensive is theft, hailstorms, tornadoes, anything else. Okay. You won't really see the word comprehensive in these auto policies anymore. It's changing to other than collision, because a lot of people were foregoing collision and getting comprehensive, thinking that it was, covering everything. And then they say, oh, I thought I was comprehensive.
Kind of misleading.
Yeah, it's pretty misleading. So it's not going to be a comprehensive a lot anymore. A lot of people are changing to other than collision. Okay. The last component here, uninsured and underinsured motorists insurance, is very vital. This, there's statistics like 1 in 5 drivers in Utah. I don't know the national statistics, but don't have auto insurance. That's not including the people who have the state minimum and who have barely enough to maybe, cover what you need. It's unfortunate. This is baked into everyone's auto policies, so you don't have to go out and get it separately. It's essentially like you're paying for other people's insurance, but it's essential because typically people who don't have car insurance aren't going to have assets to sue for, right? So in a case like this.
Well, quick question to follow up. I'm curious if anyone has this question on the webinar, but if you're in a car accident and there's injuries, so someone maybe broke a rib or broke an arm or something, and they go to the hospital, would the car insurance would be covering those costs, not your health insurance?
Right. So for others, it would be covering that. Again, you don't want to put a claim on your health insurance if someone else who's at fault can pay for
you get hit in your car
those.
and then it's not a hit to your health insurance. Their car insurance will cover what happened.
Right. Yep. And, the good thing about this is that oftentimes this liability allows you to sue for things like pain and suffering. If you end up becoming disabled, it'll cover, things above and beyond what health insurance normally does, which, remember, health insurance doesn't necessarily help with pain and suffering or, payments to help rearrange your house to make it more accessible if you end up in a wheelchair, right? Health insurance exists to keep you alive. Doesn't do much beyond that. Okay, so this is where this might go above and beyond the un and underinsured motorists.
Okay, let's cruise through this. So umbrella insurance, this is an important policy. I think depending on your situation, I mean, not everybody, I don't know. Umbrella insurance is a unique one because it's not one that's required by anybody, but it's something that you should look at, especially as you start to grow some wealth and have some assets in your life, right? So it's really the catch-all at the end. So if something were to not be covered in any other policy you have, the umbrella makes sure to cover so you don't have something huge and catastrophic happen. So is there an example where you can think of where umbrella would make more sense? I mean, when would you trigger umbrella insurance? Because most people just don't have it.
Yeah.
Unless they're really high income earners.
Right. Yeah. So umbrella insurance comes in handy again as a safety net. It doesn't come into play until your homeowners or owner or auto insurance policies exceed their limit. Okay. So it's kind of like a backup plan. For that reason, the premium's extremely low, but it's a really good safety net we typically recommend to clients because, it just takes someone tripping, on your sidewalk or something happening where you end up getting sued for that homeowner's policy to reach its limit.
But the most likely scenario, which has been starting to get removed from umbrella policies, is uninsured or underinsured motorists.
Correct.
That's the most likely risk that they're actually trying to remove because they just weren't winning in that scenario. So now you have to really make sure your umbrella policy covers that because that's most likely the claim you would ever have against that policy where they need to kick in some money and cover that. So if you make that step to umbrella insurance, it's pretty inexpensive from what I've looked at. But it's most likely to cover an additional percentage or dollar amount for uninsured and underinsured motorists. So highly important, especially as you start to get more to protect in your financial snapshot. So, all right, questions. We went along today. I hope that was helpful. The great thing about insurance is that it helps us all mitigate risk, but it's not something we're worried about often. So I think it's important. Hopefully this is a trigger for you to go back and look at what insurance you have. I don't know if there's any questions. If you have any questions, let us know. You can reach us just actually a link on our website, might be watching this. But insurance, make sure that I would encourage everyone at least once a year to really do a deep dive into every single insurance policy they have, review what's going on, review what actual insurance costs paid for. So see where you had claims and where you actually got something back, and see if there's risks that you're over insuring and some that maybe you should insure better. So appreciate everyone being here today. Anything else to add?
Yeah, no, I mean, again, it's important to approach this from a risk management standpoint. Kind of look at all the risks in your life. How can you mitigate those, reduce them, and then have the insurance as a backup? So that's everything.
Awesome. Okay. Thanks, everybody. Have a wonderful Wednesday. Appreciate you being here.